Good day, everyone. I'm Elisa Tumala, and welcome to Chapter 11 entitled Personal Risk Management, Retirement, and Estate Planning. So, while insurance focuses on safeguarding current assets, retirement and estate planning looks ahead, ensuring that future's assets are protected and optimized. Retirement planning is about envisioning and preparing for life post employment, while estate planning safeguards your asset posthumously. Planning for retirement or estate involves pondering various uncertainties like your life situation at retirement, marital status, dependents, housing situation, possible disabilities, desired activities during retirement, and potential estate taxes at the time of death. Starting early in retirement planning allows maximum time for saving your accumulate. Although your young age makes it challenging to answer this question, initiating the saving process is crucial. Flexible plans can adapt to unforeseen circumstances. 11.1 Retirement Planning Projecting Needs. Learning objectives. First, identify the factors required to estimate savings for retirement. Second, estimate retirement expenses, length of retirement, and the amount saved at retirement. And lastly, calculate relationship between the annual saving required and the time retirement. Retirement planning is essentially about setting goals and strategizing ways to achieve them. The big aspiration of having a nice life post retirement must be qualified into tangible financial needs, even though predicting exact retirement needs is tricky due to uncertainties. A proactive approach to saving helps in building financial cushion. Here is a sample case study. Chris and Sam. The couple moved to the suburbs after having children, but plan to retire in the city. Their retirement strategy involves selling their suburban home to financial a city condo, aware of potential inflation and varying real estate prices. They understand the need to project their financial situation 3 decades into the future. For Chris and Sam, retirement planning requires first, estimating capital needs for buying the condo, second, forecasting living expenses post retirement, third, assessing how long they might live post retirement to ensure they don't outlive their savings. They also need to consider the compounding impact on their savings over the 30 years. To project retirement savings, one must estimate post retirement expenses, duration of retirement, and return on savings during retirement. Even though the time horizon until retirement may be long and filled with uncertainties, using current known variables in a pragmatic starting point. Retirement and estate planning emphasizes forward thinking, protecting future assets, and quality of life. Starting early, even amidst uncertainties, provides the best foundation for financial security. Using current data and being adaptable can guide one's approach to securing their desired retirement lifestyles and posthumous assets distributions.
Estimating annual expenses. So, one approach is to assume that your current living expenses will remain about the same in the future. Given that over the long run, inflation affects the purchasing power of your income. So, you factor in the effect inflation may have so that your purchasing power remains the same. So, for instance, your living expenses are around 480,000 per year, and you'd like to have that amount of purchasing power in the retirement as well. Assuming your cost of living remain constant, if you are 30 years from retirement, how much will you be spending on living expenses then? So the overall average annual rate of inflation in the Philippines is about 6.1% on the year 2023. So you would have to spend 480,000 multiplied by the estimated rate of inflation, which is 6.1%, multiplied by 30 years. So this is the amount per year to maintain your standard of living 30 years from now. You may use your current expenses as a basis to project a more or less expensive lifestyle after retirement. So you may anticipate expenses dropping with fewer household members and dependents. For example, after your children have grown, or you may wish to spend more and live a more comfortable life doing things you've always wanted to do. So in any case, your current level of spending can be a starting point for your estimates. Estimating length of retirement. So how much you need to have saved to support your annual living expenses after retirement. So it depends on how long those expenses continue or how long you live after retirement. So this statistic shows the average life expectancy at birth for women in the Philippines, which was about 71.48 years, while life expectancy at birth for men was about 67.17 years on average. So the next reporter will going to discuss on how to estimate the amount needed at retirement.
Good morning, everyone. So let's tackle about estimating the amount needed at retirement. So you can use what you know about time and value to estimate the amount you would need to have saved up by the time you retire. Your annual expenses and retirement are really a series of cash flows that will grow by the rate of inflation. At the same time, your savings will grow by your rate of return, even after you are making withdrawals to cover your expenses. Say that when you retire, you have your retirement funds invested so they are earning a return of 5% per year. So assume an annual inflation rate of 3.25% and that your annual expenses when you retire are $65,269. So as you can see sa chart, makita nimo diha ang years after retirement, annual expenses, and ang value sa imuhang retirement. So the amount you need at retirement varies with the expected rate of return on your savings. So while you are retired, you will be drawing income from your savings, but your remaining savings will still be earning a return. So the more return your savings can earn while you are retired, the less you have to have saved by retirement. The less retirement your savings can earn in retirement, the more you need to have saved before retirement. So the total amount needed at retirement is only about $1.5 million if your remaining savings will earn 5% while you are retired. But if that rate of returns is only 2%, you would have to begin retired with almost $2.5 million. So let's assume your return on saving is 5%. If you want to have $1,590,289 in 30 years, when you retire, you could deposit $367,957. So today, and just let it compound for 30 years without withdrawal. Let's proceed estimating the annual savings for retirement. So in the example above, you make a regular annual deposit in your retirement account for the next 30 years. Each deposit will have to be $23,936, assuming that your account will earn 5% in the 30 years. So if the rate of return for your savings is less, you would have to save more to have more at retirement. If your retirement savings can earn only 2%, so for example, you would have to deposit $60,229 per year to have $2,443,361 when you retire. So your retirement account grows through your contribution and through its own earnings. The more your account can earn before you retire, the less you will have to contribute to it. On the other hand, the more you can contribute to it, the less it has to earn. So the time you have to save until retirement can make a big difference to the amount you must save every year. So the longer the time you have to save, the less you have to save each year to reach your goal. So this shows the idea as applied to the example above, assuming a 5% return on savings and a goal of $1,590,289. So the longer the time you have to save, the sooner you start saving, and the less you need to save each year. So for example, the above, Chris and Sam are already in their 30s. So they figure they have 30 years to save for retirement. Had they started in their 20s and had 40 years until retirement, they would not have to save so much each year. If they wait until they are around 50, they will have to save a lot more each year. The more you have to save, the less disposable income you will have to spend on current living expenses, making it harder to save. Clearly, saving early and regularly is the superior strategy. When you make this calculation, be aware that you are using estimates to figure the money you will need at retirement. You use the expected inflation rate based on its historic average to estimate annual expenses, historical statistic on life expectancy to estimate the duration of your retirement, and an estimate of future savings returns. Estimate must be adjusted because things change. As you progress toward retirement, you'll want to reevaluate these numbers at least annually to be sure you are still saving enough.
Next, let us proceed to the chapter 11, which is the retirement planning ways to save. The learning objectives first is compare and contrast employer, government, and individual retirement plans. Second, explain the differences between a defined benefit plan and a defined contribution pension plan. Third, summarize the structure and purpose of Social Security. Fourth, state the difference between a traditional IRE and a Roth IRE. Fifth, identify retirement plans for the self-employed. While knowing the numbers clarifies the pictures of your needs, you must reconcile that picture with the realities that you face now and how will you be able to afford to save what you need for retirement. There are several savings plans and structures to help you save some of your tax advantages. Some don't, but first you need to make a commitment to save. Saving means not spending a portion of your disposable income. It means delaying gratifications or putting off until tomorrow what you could have today. That is often difficult. As you have many demands on your disposable income, you must weigh the benefit of fulfilling those demands with the cost of not saving for retirement. Even though benefit in the present is much easier to credit than benefit in the future, once you resolve to save, however, employer, government, and individual retirement plans are there to help you. Next, let us know what is employee retirement accounts. Employer may sponsor pensions or retirement plans for their employees as part of the employee's total compensations. There are two kinds of employer-sponsored plans, defined benefit plans and defined contributions plan. A defined benefit plan is a retirement plan sometimes called a pension plan, funded by the employer who promises the employee a specific benefit upon retirement. The employer can be a corporation, labor union, government, or other organization that establishes a retirement plan for its employees.
Good day everyone. So we are now on Chapter 11, U.S. Government's Retirement Account. The federal government offers a mandatory retirement plan for all citizens except federal government employees and railroad workers known as Social Security. Social Security is funded by a mandatory payroll tax shared by employee and employer. That tax commonly referred to as Federal Insurance Contribution Act or FICA. Also fund Medicare. Also, we see that on Chapter 10, Personal Risk Management Insurance. Social Security was signed into law by President Franklin D. Roosevelt in 1935 to provide benefits for old age and survivors and disability insurance for workers, or OASDI. The Social Security Administration was established to manage these safety nets. Keep in mind that in 1935, when Social Security was created, life expectancy for American males was only 65, the age of the Social Security eligibility. Social Security was never meant to be a retirement income, but rather a supplement to retirement income. Merely is a measure of protection against poverty-ridden old age. As part of the Federal Employees Retirement System, the U.S. government also offered special retirement plan for its employees, including a TIF Saving Plan or TSP for civilian employed by the United States and member of the uniformed services like Army, Navy, Air Force, Marine Corps, Coast Guard, National Oceanic and Atmospheric Administration, and Public Health Service. Nevertheless, many plans for public employees are defined benefit plans providing annuities upon retirement, similar to but separate from plans for employees in the private sector.
Next is individual retirement accounts. Any individual can save for retirement without a special account. But since the government would like to encourage retirement savings, it has created tax advance accounts to help you do so, because these accounts provide tax benefits as well as some convenience. It is best to use them first in planning for retirement, although their use may be limited. Individual retirement accounts were created in 1974 by ERISA. They were initially available only to employees not covered by an employer's retirement plan. In 1981, participation was amended to include everyone under the age of 70. So the traditional RIA is an account funded by tax-deductible or non-deductible contributions. Deductible contributions are taxed later are withdrawn, but non-deductible contributions are not. In other words, you either pay tax on the money as you put it in, or you pay tax on it as you take it out. A great advantage of a traditional IRA is that principal appreciation, like interest, dividend, income, or capital gain, is not taxed until the funds are withdrawn. Withdrawals may be begin without penalty after the age of 59. Funds may be withdrawn before age 59 but with penalties and tax applied. Contribution may be made until age 70, at which time required minimum distributions or withdrawals of the fund must begin. The Roth IRA created in 1997 contributions are not tax deductible, but withdrawals are not taxed. You can continue to contribute at any age and you do not have to take any minimum required distribution. The great advantage of a Roth IRA is that capital appreciation is not taxed. A rollover is a distribution of cash from one retirement fund or another. Funds may be rolled into a traditional IRA from an employer plan. You may not deduct a rollover contribution since you have already deducted it when it was originally contributed, but you are not taxed on the distribution from one fund that you immediately contribute to another.
Hi everyone, I am Magda Gabriel F. Avonilio and I am going to discuss to you about self-employed individual plans and estate planning. People who are self-employed wear many hats: employer, employee, and individual. To accommodate them, there are several plans that allow for deductible contributions. A simplified employee pension or SEP is a plan that allows an employer with few or even no other employees than himself or herself to contribute deductible retirement contributions to an employee's traditional IRA. Such an account is called a SEP IRA and is set up for each eligible employee. Contributions are limited in any year. They can't be more than 25% of salary or $46 in 2008, which is less. If you are self-employed and contributing to your own SEP IRA, the same limits apply, but you must also include any other contributions that you have made to a qualified retirement plan. A savings income match plan for employees, or SIMPLE, is a plan where employees make salary reduction before tax contributions that the employer matches. If the contributions are made to the traditional IRA, the plan is called a simple IRA plan. Any employer with fewer than 100 employees who are paid at least $5,000 in the preceding year may use a simple plan. In the context of a simple IRA plan, employees can make pre-tax contributions to their individual traditional IRAs, and employees have the option to match these contributions. However, contributions are subject to limits, with deductible contributions capped at $10,500 in 2008 for individuals under the age of 49. This type of plan provides a straightforward and accessible way for small businesses to establish retirement savings options for their employees. Your estate includes everything you own. Other aspects of financial planning involve creating and managing your assets while you are alive. Estate planning is a way to manage your assets after your death. Age is not really a factor because death can occur at any time, at any age, by any cause. Arranging for the disposition of your estate is not a morbid concern but a kindness to those you leave behind. Death is a legal and financial event, and in some cases, a taxable event as well as an emotional one. Your loved ones will have to deal with the emotional aftermath of your loss and will appreciate your care in planning for the legal and financial outcomes of your death. Contrary to being a morbid consideration, estate planning is a considerate and pragmatic act directed to those left behind. It involves offering guidance for the allocation of assets and preparing for the comprehensive legal and financial implications of the individual's death, serving as a vital measure to facilitate a smooth transition of assets and alleviate burdens for loved ones during a challenging period. Alleviate.
Good day everyone, my name is Salome Cabanas and I'm going to discuss about the wills, trust, and gifts. Now let's define first what is will. Will is a legal request for the distribution of your estate, that is, assets that remain after your debts have been satisfied. If you die intestate or without a will, the laws of your state of legal residence will dictate the distribution of your estate. In simpler terms, will is a legal document containing instructions as to what should be done with one's money and property after one's death. Now, in writing a will, you can write your own will so long as you are legal adult and mentally competent. The document has to be witnessed by 2 or 3 people who are not inheriting anything under the terms of the will, and it must be dated and signed and in some states notarized. Then we have different ways in creating a will. It can be through a holographic will, which is handwritten and it may be more difficult to validate. Next is a statutory will, is a pre-printed will that you can buy from a store or in a software package. However, since a will is a legal document, having yours drawn up by a lawyer may better ensure its completeness and validity in court. We also have what we call the probate. So when we say probate, this is a legal process of validating a will and administering the payment of debts and the distribution of assets by probate court. Probate courts also distribute property in the absence of a will. Probate is not required if the deceased owned assets of a little value allowing for transfer without court supervision, owned assets jointly with or payable on death to another person, own assets naming another person as beneficiary, and lastly, held all assets in a living trust. Then there are several types of wills: simple will and traditional marital share will. A simple will leaves everything to a spouse for comparatively small estates that are not taxable. A simple will also may be the most appropriate kind. Next is a traditional marital share will, leaves one half of the estate to spouse and other halves to others, usually children. This may lower any tax burden on your estate and your spouses. Now the next topic is about trust and gifts. Let's define first the trust. So when we say trust, this is a legal entity created by a trustor or a grantor who owns assets managed by a trustee or trustees for the benefit of a beneficiary or beneficiaries. Then we have several types of trust: a testamentary trust, a living trust, revocable living trust, and irrevocable living trust. A testamentary trust may be established by a will so that beneficiaries who are unable to manage assets, which are the minor, children, or disabled dependents, can benefit from the assets but have them managed for them. A living trust is established while the grantor is alive. Unlike a will, it does not become a matter of public record upon your death. Then we have a revocable living trust, can be revoked by the grantor who remains the owner of the assets at any time. Such a trust avoids the probate process but may not shield assets from estate taxes. Now lastly, an irrevocable living trust cannot be changed. The grantor gives up ownership of his or her assets, which passes to the trust, avoiding probate and estate taxes. However, the trust then becomes a separate taxable entity and pays tax on its accumulated income. Now take note, another way to avoid probate and estate taxes is to give assets to your beneficiaries while you are alive. Ownership of the assets passes to the beneficiaries at the time of the gift, so the assets are no longer included in your estate. Hence, most trusts, whether testamentary or living, revocable or irrevocable, are created to avoid either the probate process or estate taxes or both.
Good day, everyone. I am Jadala Vergonzado, and my topic is all about estate taxes. So, estate taxes reduce the amount of your estate that goes to your beneficiaries, and one main goal of the estate planning is to minimize these taxes. In the United States, you must file an estate tax return if your taxable estate is above a certain threshold, which can vary by state. A taxable estate is calculated as the gross estate minus allowable deductions. The gross estate includes all the property you owned at the time of your death, life insurance proceeds, certain annuities, and property transferred shortly before your death. Deductions include debts you own, funeral expenses, assessed past to your surviving spouse, charitable gifts, and state estate taxes. In Figure 11.12, it is the estate tax filings in 2007 and shows the scope of the estate tax in the U.S. economy for 2007, the latest year for which data is available. Inheritance taxes, on the other hand, affect the assets your beneficiaries receive, and this can be expensive. Some states have redefined or repealed their inheritance tax law to alleviate this burden. If your taxable estate has non-liquid assets like a home or business, your heirs might have to sell them to pay the estate taxes. To prevent this, some estate plans involve purchasing life insurance to cover the expected tax amount, ensuring a source of liquid funds for tax payments. Minimizing taxes is a key part of estate planning. The primary goal is to provide for your dependents and ensure your assets are distributed according to your wishes. Estate planning balances financial and family objectives.